people from Corn, Riverland, and far and wide today. For those of you who don't know me, I'm Kathy Ramsey, Partnerships Manager here at TIC SA. For those, before we get started, I'd like to kick it off with our welcome to country and acknowledge I'm hosting this webinar from the lands of the Kaurna people. I'd also like to acknowledge the traditional custodians of the various lands where you all join us from today, and the First Nations people participating in this webinar. I pay my respects to elders past, present and emerging, and celebrate the diversity of First Nations people and their ongoing connections to ongoing cultures and connections to the lands and waters of South Australia. Our In Conversation series is a program undertaken monthly to keep you, our wonderful South Australian tourism community, engaged and informed. I'm really wrapped for today's session and look forward to bringing our speakers to you shortly. But first, just a couple of housekeeping matters. If everybody could please keep their microphone on mute. We will use the chat function and encourage you to use the chat functions. We like to make these sessions as interactive as possible. So use the chat function for any questions and we'll endeavour to work through them in today's session, but I also allow a bit of time at the end for Q&A. This session is going to be recorded and distributed on the conclusion of the event. So, without doubt, today's session, we know it's about the current economic and financial state of South Australia, but also the country. We're not alone in what we're facing here across Australia. There's no doubt that costs and interest rates have risen significantly since about May last year and continuing to rise. And the cash rate now at its highest since May 2012. Businesses are feeling it even more than ever. Knowing where to look for support can really be challenging at times. So today, I'm really pleased to be having our wonderful partner at Bank SA and Pat Bustamante, who will provide us with the economic update, but also followed by Loftus, founder of Loftus Business Advisory, just to give us some real tangible tips on what we can be doing in navigating the current market in response to the lay of the land that Pat's going to give us in his update. So welcome to you both, Owen and Pat. First, if you could perhaps tell us a little bit about yourselves. Pat, yourself first.
Yeah. Hi everyone. So my name is Pat Bustamante and I'm a senior economist at the group. So in terms of what I do, my focus is on the Australian economy. There's a lot of forecasts, there's a lot of analysis and briefing on where we see the economy going, with a particular focus on interest rates and the exchange rate. So that's what I'm going to talk to you today. So yeah, look forward to presenting our outlook.
Thanks, Pat. And Owen, welcome.
Thanks, Kathy. Yeah, super excited to follow Pat and his presentation, really giving some tips of what I used to do in the hotel group that I used to run, share with my clients now. So about a dozen tips to help fight back against these rising interest rates and cost of doing business. So look forward to presenting that after Pat.
Lovely, great. Thank you. So Pat, if you wanted to kick it off, I believe you've got a presentation to share with us today. Let's jump straight into it, lads. Over to you, Pat.
That's great. Alrighty. So I'll just share my screen now. So I'm hoping that's coming through okay. Excellent. Alrighty, so as I said, my name is Pat Bustamante, and what I plan to do is talk to you about where we see the economy heading over the next year or so, and kind of what are the risks as well. As I'm sure everyone's aware, there's been quite a bit of financial market turbulence over the last few weeks. So basically try to spell out what that means for the Australian economy going forward. So I've got quite a bit of material to cover, so we'll get into it straight away. So normally when I talk about the Australian economy, I'll delve straight into the domestic data, but we're living through quite unique times at the moment. And what happens in Australia and indeed globally will be determined by these three kind of key factors that are affecting most advanced economies across the globe. So I'll just go through them quickly. So the first one is that, demand remains really resilient. So once, when we saw COVID restrictions ease, towards the back end of 2021 and 2022, there was a lot of pent-up demand. Consumers across, developed economies spent a lot, and that led to unemployment rates falling across most kind of OECD countries. And not only falling marginally, but actually falling to multi-decade lows. And we saw the same pattern emerge in Australia. So you can see that on the chart on the right-hand side there. We saw the unemployment rate decline in Australia to 3.4% late last year. And that was close to a 50-year low. And the labour market in South Australia has followed a very similar pattern. And we're sitting with the unemployment rate at under 4% today. So the significance of this is that when you have tight labour markets, there's a risk that wages growth becomes unsustainable and, interest rates have to go higher. So that's why central banks, including our very own Reserve Bank, is monitoring this situation very closely. So the second global trend that's emerged is that, inflation has really spiked. And we saw inflation spike in 2022. And that was really on the back of the story that I mentioned earlier. So there was strong demand on the back of all the support measures which governments provided during COVID. When restrictions eased, people started spending. That increased demand across the globe. That came up against supply side constraints, particularly when it comes to shipping and other kind of supply chain measures, which I'll delve into a bit later. And that ultimately meant that prices really spiked last year. Now that's started to come off. So if you look at that chart on the left-hand side there, when you look at the US and Europe, Europe in particular saw inflation peak at, over double digits. But now it's come down, and that's come down basically on the back of goods inflation, which I'll get into a bit down the track. And we're seeing a similar pattern emerge in Australia, although we tend to lag what's happening globally by 1 or 2 quarters. So in our view, we saw inflation, or the worst of inflation, peak at the end of 2022 at about 7.8%, and we're expecting inflation to fall over the next 2 years. So the third trend that's affecting pretty much every economy across the world is very aggressive hiking by central banks. On the left-hand side chart there, you can see policy rates, including our very own cash rate, has basically shot up in a vertical line since over the last year or so. We've never seen that synchronized kind of tightening in the past. And in Australia, so if you look on the right-hand side chart there, the blue line, the Reserve Bank has hiked by about 350 basis points since May last year. And that's been the most aggressive hiking cycle since the late 1980s. And even then, you can make the case that we've fallen behind other central banks, such as the Fed and the New Zealand Central Bank, who have hiked by 450 basis points. So that's an additional 100 basis points on where we are. So it kind of just, it's quite stark, the magnitude of the hiking that has occurred to date. I guess one of the risks with hiking so quickly, so aggressively, is that it leads to financial market instability. And we've seen that play out just over the last couple of weeks. So when interest rates go up, the value of fixed income assets such as government bonds goes down. And we saw 3 kind of medium-sized banks there in the US, so Silicon Valley Bank, Signature Bank, and more recently First Republic Bank. So basically they, on their asset side of their balance sheet, they held a lot of government bonds. On the liability side, they were funding those bonds through deposits. So once, once it became, I guess once there were rumours flying around that these banks could potentially come under liquidity strain, you saw a lot of deposits being withdrawn. So these banks had little option. They basically had to sell their assets and make, convert what is a paper loss into an actual loss, or raise new capital on equity markets. And, a lot of investors weren't willing to provide that capital given the turbulence that was being experienced. So basically, the first two banks were taken over by the US regulators. First Republic Bank was given a deposit infusion by 11 other big banks, which was led by JP Morgan. And then this instability spread to Europe last week. So we saw Credit Suisse, the share price of Credit Suisse fall by 30% in one day. And that was on the back of their largest shareholder basically saying the largest shareholder, which is the Saudi National Bank, basically saying they're not going to inject more capital into Credit Suisse. And that led to a run on the equity position of Credit Suisse. So markets are quite fragile at the moment. They're quite nervous. They're quite nervous about the financial health of financial institutions, given how much interest rates have increased, and about the outlook for the economy, given again how much interest rates have increased. And when that happens, there's a bit of a flight to quality, and investors move away from risky assets such as shares in banks to safe assets such as government bonds. And just last week we saw government bonds, the yields on government bonds fall by a record pace, basically, the sharpest fall since 1982, which again kind of underlies how the instability in financial markets in the US and in Europe as well. So I could pull up a similar chart for Europe. And in Australia, where even though our banks are well capitalized, they're well regulated, we're not immune to this indirect volatility. And we saw this kind of flight to quality occur last week as well. We saw yields on government bonds fall quite sharply. And we also saw credit default swaps for the banks increase quite sharply. So I don't know if you can see that chart on the right-hand side there. So that essentially means that markets are pricing in, greater risk, or basically they need to get compensated more to take on the risk of holding bank equities. So that's kind of the backdrop in the global economy. So given that rather somber backdrop, what we're expecting to occur this year is for the Reserve Bank to basically, be at the end of its cycle or close to the end of its cycle. We're expecting inflation to fall this year and next. And we're really expecting the labour market to soften and to loosen. And that's on the back of migration levels boosting labour supply, and also a reduction in demand on the back of higher interest rates. So when you put all that together, we're expecting the economy to slow quite significantly and the unemployment rate to increase over the next 2 years. So just going through each of those forecasts. So as I mentioned earlier, the Reserve Bank has increased the cash rate from 0.1% in April last year to 3.6% a few weeks ago. So market pricing on the back of the turbulence that we saw over the last 2 weeks has moved quite dramatically. So only 2 weeks ago, markets were pricing in a terminal cash rate of 4.2%. So about 60 basis points of additional tightening by the Reserve Bank. Now markets are telling us that given the instability in financial markets and given the uncertainty over the real economy, the hiking cycle is basically done. And if anything, a full interest rate cut is being priced into markets by July this year. So that's quite a radical shift in terms of the outlook when it comes to interest rates. So in terms of our view,
sorry, Pat, just to butt in there, and when we're looking at this sort of the cycle of the cash rate, obviously in February it hiked by 0.25%, and they're determined the RBA is determined to really rein in that household spending. So do you sort of still forecast if there's going to be a potential cut in July? Do you still forecast, and with it to peak at 3.85%? Sort of, you think it will be a couple of more raises to come potentially?
So I guess I'd answer that, by looking at kind of two factors. So markets have penciled in that cut because essentially what they're factoring in there is like a de facto kind of market tightening. So when, credit markets, there's a lot of uncertainty and there's not much liquidity. It means the cost of raising capital, by banks, by corporates, that all increases, autonomously or independently from what the Reserve Bank does. So I guess markets are pricing in that kind of de facto tightening to occur and to drive, a real impact on the economy. And when it comes to, the Reserve Bank did come out in February and the governor was quite kind of candid, forthright, and said, we're going to get inflation down, we're going to continue to hike. But since then, we've seen a run of economic data that's come in a lot softer than what we're expecting. And I've got a chart down further down the pack, which basically shows that spending per person went backwards in the December quarter. So the governor would have known that in February when he came out. But it's showing that, the high interest rates are already starting to bite. And, the interest rate increases to date haven't flown through to households or businesses. And as that continues to flow through, we're expecting, demand to really fall off and to get that inflation to come down. So I guess that's how I
appreciate that clarity.
No worries.
Okay.
So in terms of our view, we basically got one more in there. But again, I mean, we could be at the end. It really depends on what inflation does in Q1 this year. So when it comes to inflation, so we're really expecting inflation to have peaked in 2022, and we're expecting inflation to come down to 4.5% by the end of 23 and 3% by the end of 24. And we're quite confident on that because a lot of that inflation spike has been driven by the prices of goods, as you can see from that chart on the right-hand side there. So that the blue part of those bar charts have really driven the high inflation that we've seen over the last year or so. And that's on the back of one, strong demand, but also supply side constraints that I spoke about earlier. So basically, that you had China still in lockdown last year, which meant, global supply chains weren't really working efficiently. You had Russia's invasion of Ukraine, which saw the price of food and oil and energy commodities really spike, and that started to come off now. And you also saw the price of international freight and shipping costs really spike on the back of that strong demand. And again, that started to normalise now. So we're really confident that we're going to see inflation come down this year on the back of goods inflation. And this is just telling that story that I kind of outlined earlier. So from the peak that it reached late last year, your energy commodities, so your oil, the price of oil and the price of thermal coal has come down by like 50%. So that's going to flow through into prices of goods. The price of wheat, so food, has also come down by more than 50% since the peak last year. So it's just going to take a quarter or two, but we're really confident that's going to flow through into goods inflation. What was quite stark is the global shipping costs. So when, in 2021, when countries started opening up, that spiked by 11 times where it was pre-pandemic. But now that's come back. And again, it's just going to take a bit of time, but that's going to flow through into goods inflation. And we're going to see that moderation there. And the final chart there on the right-hand side there is, it kind of tries to measure how efficiently global supply chains are working. And we're really back to where we were pre-pandemic. And that was really kind of supported with China opening up earlier this year, which meant all those supply chains which used Chinese output as inputs could come back online and really boost supply of goods going forward. So we're really confident on the goods side. On the services inflation side of things, a lot will be determined by what wages do. So we've seen wages tick up recently on the back of the tight labour market. So the last read was that inflation was running at about 3.3%, which is consistent with as the governor says, consistent with the inflation target. We're forecasting a bit of an acceleration in wages. So consensus, and we're pretty much in line with consensus, is that wages will reach a peak of about 4%. It may not get there, but we're not going to see the 6-7% wage growth that we saw in the US, that we saw in the UK or in Europe. So the risk of a wage price spiral is basically very, very low in Australia. And one of the reasons it's very low is because we've had this additional supply of labour through migration. So just in the September quarter, so there was some data released last week, we saw migration increase by more than 100,000 people, which was a record high. So that's leading to an increase in labour supply. And we've seen a similar pattern emerge in South Australia as well. So net overseas migration has bounced back once on the back of the reopening of international borders. But I guess South Australia has also had the added benefit of having interstate migration. So we've seen people move from New South Wales, from Victoria into South Australia. So a lot of that could be supported due to the more flexible working environment. But in my view, a lot of it's also got to do with house prices, and we'll touch on that when we get to house prices down the track. So there's been an injection into labour supply, and that's meant that momentum in the labour market is really turning, and you can see that on the chart on the left-hand side there. So basically, your working age population has made a V-shaped recovery. We're running at a record pace. We've never run at that pace of almost 500,000 people through the year. So labour supply is increasing quite sharply. At the same time, we're seeing labour demand is dropping off also quite sharply. So you can see that blue line on the left-hand side there. So we're expecting those dynamics to continue going forward. And if labour supply continues to increase and labour demand continues to ease, we're going to see the unemployment rate tick up and wages growth moderate. And that's what we've got in our forecast. And some of those forward indicators when it comes to labour demands are also showing that that's easing. So job ads there on the right-hand side chart there have well and truly come off their peak. And the number of applicants per job vacancy has also increased quite significantly over the last 6 months or so. So we're seeing those dynamics sort of play out, but that's only going to get worse as the interest rate hikes to date continue to flow through into household budgets and the budgets of small businesses. So this is using some data that we got from the December quarter national accounts, which was released in early March. And it basically shows that interest on mortgage interest spiked up to $20 billion over the quarter. And that's the highest ever. And that doesn't include all interest rate hikes to date. So it takes about 3 months for an interest rate hike to flow through to minimum repayments for variable mortgage holders. And obviously, we've got a large stock of fixed rate mortgages that haven't experienced any change in their minimum repayments. But we're expecting a large share to roll off as we head into 2023. So this shows that interest rates are biting. They're reducing disposable income because people are using more of their income to pay for interest on their mortgage. And as I mentioned earlier, if you look at that right-hand side chart there, you can see so spending per person actually went backwards in December quarter. So it's quite significant. It means, what we spent, per person, what all of us spent during the September quarter was higher than what we spent in December quarter, which is usually, tends to be stronger given that we're going into a holiday season. There's Christmas, preparing for New Year's and stuff like that. So it's quite significant that, interest rates are already starting to bite and we haven't seen the full pass through yet. The other channel through which high interest rates feed through to spending is through asset prices. So asset prices, including house prices, decline when interest rates go up. And we've seen house prices across Australia fall by about close to 10%. We're expecting a little more to go. We're expecting by the time the Reserve Bank goes on hold for house prices to fall anywhere between 10 to 15%. But what's unique about South Australia in particular is that it's outperformed every other state and territory. So let's just look at that table on the right-hand side there. So looking at regional South Australia, so excluding Adelaide, every other housing market. So during COVID, you saw house prices increase by almost 50% over 2 years. So that's a massive increase. In terms of decline from the peak, we've seen basically prices go sideways. They haven't declined like in other states and territories. And if you look at kind of demand and supply dynamics, there's not much downside there. And a similar pattern emerges when you look at Adelaide. So across COVID, we saw house prices increase by almost 45%. Since the Reserve Bank started hiking, we've seen prices go down by 2%, which is it's quite a small fall when you consider in Sydney, house prices have fallen by more than 10%. We're expecting a bit more downside when it comes to Adelaide, but it's been quite stable. And part of the reason why it's been quite stable is because demand's been quite strong. And we saw population growth in South Australia has been quite strong, both due to migration, but also interstate migration. So people moving from, Victoria and New South Wales into South Australia. And also because if you look at that second last row there, the actual median house price in South Australia, particularly like in the regional areas, is a lot lower than house prices elsewhere. So across Australia, the median house prices is about 700K. In regional South Australia, it's about 350. So half the value of what it is across Australia. So it's more affordable. People aren't under financial strain to pay off the mortgage, to pay off those houses. So it's meant that it's kept up its value. So it's really it's really a standout when it comes to property prices, South Australia. So when you put all that together, we're forecasting a very sharp slowdown in 2023 and 2024. So we're expecting the economy to grow by, basically 1% in 2023 and 1.5% in 2024. When you consider that the average growth in the Australian economy is about 2.5%, that is quite a significant slowdown. And as a result of that slowdown, we're expecting the unemployment rate to increase to about 4.5% by the end of this year, and then just under 5% by the end of 2024. So basically, it's not the the most positive outlook, but I guess the silver lining is if these forecasts are right and we get inflation down and the unemployment rate remains under 5%, we'll be in a better shape than when we were going into the pandemic, when the unemployment rate was closer to 5.5%. So I guess that's the only silver lining, but it looks like this year is going to be a tough year when it comes to the consumer, given how much interest rates have risen over the last year or so. So that's all I had for formal kind of slides, but happy to take questions now or down the track. And I'll just put out our disclaimer as well.
Perfect. Thank you so much, Pat, for your time and delivery there. And like what you said, it's a bit, we've been through volatile times, but the South Australian tourism industry have been built tough, and we know we've been through some tough times. But I also probably go, it's a bit of doom and gloom, but I can also see some positives in that. The Reserve Bank were pushing up interest rates to really put a stretch on household finances, and we can just start to see, like you said, that information come through from the December quarter. So the positive there's light at the end of the tunnel in terms of inflation is slowly, getting a hold of inflation, and potentially, those the cycle of interest rate hikes could be coming to an end, which is pleasing. in terms of that sense. So, but also a little positive I pulled out of that is about net overseas migration and the labour market, and particularly our industry sector has been hamstrung by workforce challenges. So that's a real, when just trying to find some silver linings in all that for people on our session today. And I really believe that workforce situation is going to help our industry as well once we start to see that flow through.
Yeah, I totally agree with that. And we've already started to see those kind of skill shortages dissipate essentially. The other thing I didn't put up is that, tourism and overseas arrivals on a short-term basis has also picked up quite strongly. And that's obviously good, positive for tourism, both in South Australia and across Australia. So that's another kind of silver lining as well.
Absolutely, to see that return of the international tourists when they do have a higher average spend per domestic tourist is really positive for our industry, and particularly as household spending might be tightening a little bit on the domestic market. It's great to see that international piece will slowly start to come through to South Australia as well. Now, obviously, you touched on inflation and obviously costs of goods and services, and that's what really hits our members being operators as well. And we'll flip to Owen quite shortly, just as he can start to talk about how we can help control those costs and some tips we can do in business there. But before we flick to Owen, I just wanted to introduce to you all David Brownie from Bank SA. And David Brownie does have a really great offer that he wants to share with all our TIC SA members, and very generous offer from Bank SA, and really, quite helpful as we are all watching our own personal costs at these times. Over to you, David.
Good on you, Kathy. Thanks very much, and really appreciate the opportunity for Pat and myself to join you today. Really hope you enjoyed Pat's presentation. For those of you I haven't yet met, David Brownie, as Kathy mentioned, I'm Bank SA's corporate partner manager, managing SA&T, and have the absolute privilege of overseeing our partnership with TIC SA. Just a couple of things from me as we wrap up from a bank's perspective. As a priority, because it's really important, a huge thanks to Sean, Kathy and Finn for giving us this opportunity to provide you with our outlook on the economy and where we expect it to go over the next year or so, including our call on RBA and interest rates. And for those of you who may not be aware, Bank SA has a special home loan offer that's available for TIC SA members and their employees, and this is how it works. Because you're a TIC SA member or an employee of a TIC SA member, Bank SA will give you a $1,000 cash back when you either purchase or refinance your home loan direct to Bank SA. And when it comes to refinancing, this $1,000 is in addition to any other offers that are available in the market by Bank SA at the time. So Bank SA currently has a $4,000 cash back for refinances, so that makes it $5,000. So if you wander into any Bank SA branch and identify yourself as a TIC SA member or an employee of a TIC SA member, our home finance manager will then apply a special code to ensure you receive the cashbacks you're entitled to. If you have any questions or you'd like a follow-up call, please contact me at david_brownie@banksa.com.au or 0466 404 074. And that's it from me. Thank you very much, everybody.
Great. Thank you, David. And we'll send out some further details to everybody on that post with the recording of this webinar session. Over to you, Owen. So as we know, Pat has given us a landscape of the current situation, but also the forecast. And as we know, typically the cost of doing business, it came through in our latest industry barometer report. The cost of doing business is really a key challenge that's facing our members at the moment. 48% of our members actually, reported that through the barometer report. So I'm really keen for you to impart some of your generous tips and knowledge on how we can start some things we can start to look at within our own businesses to set ourselves up for at least the next 12 months, but also beyond. Some smart things there. Over to you, Owen.
Thank you, Kathy. So I'll just share screen here. Right, just make sure everyone can see that presentation there. Yeah, fantastic. Firstly, thanks so much to Kathy and Tourism Industry Council for the opportunity. Obviously, I'm part of the Tourism Industry Council, but it's great to be able to share some of my tips that I generated over a period of time, nearly 3 decades, with the hotel group that I used to work with and now share with my clients. So all up, I've got 148 areas that I share with my clients to help protect and build profit. Today, I think I'll share about a dozen of those with you with the time that we have. A big thank you to the Westpac Group and Bank SA for our partnership as well. And great to hear from Pat, real high level oversight of where the economy is and where it's headed. So from my side, what I see on the accommodation side of tourism, which is a lot of my clients, and you see some of my clients listed there on the bottom, the average, say a 40 or 45 room hotel, their costs with inflation, with interest rates, with utilities, with wage rates up 5%, $140,000 has disappeared off their bottom line, just with those increased costs alone. So it's a significant impact, but there's many ways that you can fight back to protect profit, which we'll go through now. So I'll give you a couple of different tips. So number one that I like to share with my clients is firstly work out who's ripping us off. It's quite a in-your-face statement, but identifying your 5 top spend areas, so going to your profit and loss, looking at the top 5 areas that you spend, and then pricing those areas where you can with someone else. A lot of businesses don't do this because it takes time, and time that they generally don't have to go out and tender. So really encourage you, if you're not tendering regularly on especially higher or bigger spend areas, inevitably there's been cost creep over a period of time. And your suppliers know it. They know if you haven't repriced with them, and generally they won't look after you as well, is my observation. I've put a couple of examples there at the bottom of significant areas that I've seen with hotels and other businesses. Insurance, we know, is going up significantly as risk has increased. And there's quite a few different areas that you can do in terms of your excess. Challenge the bank on the excess that you're paying. The higher excess you're prepared to pay, the lower the cost of the premium, but also what areas you insure. Make sure you're not insuring or paying for areas that you don't actually need insurance, and maybe increase your excess in some of those areas that are less important. Lift maintenance. With my average client, just by pricing with them, I'm seeing a 50% reduction in lift maintenance costs, which is in the thousands of dollars per year. And waste removal, for those that not just putting out the wheelie bins, but you got the big Colex bin. Significant increases have gone through that area. If you're not pricing re-tendering with waste companies, there's thousands of dollars potentially that could be saved there. So yeah, I have been a bit blunt. Who is ripping us off? It's really taking that view of, unless I am asking the question with my suppliers, inevitably some will not be treating your business particularly well with rising costs. The next one is they're charging how much, and it's comparing your pricing. So it's finding a similar product to yours, a similar standard. Doesn't have to be in the same market, might be in an interstate market if you've got quite a unique product, and look at what your competitors are charging for a similar offering as to yours. 8 times out of 10, I would estimate that with my clients, when they do this, they actually find that they're quite underpriced within their market, or if they've got a unique offering in a state or national context, that they're leaving money on the table. So we're talking about protecting profit. Income is a great way to do that. We can do it through our income. We can do it in expenses and efficiency. But when was the last time that you actually went and had a look at your competitors, direct competitors? What are they charging if they've got a comparable product? Or again, if you've got a unique product interstate or nationally, what are other people charging, again, for a similar offering? There's definite money that can flow straight through to your bottom line. Number 3 is, who can I use less often? I used to say, who can I see less often? But I now change that, who can I use less often? And what we quite often find with our clients is that in particular years, if you look at your profit and loss for the last 12 months, there'll be areas where you've uncharacteristically spent more than what you had in previous years. So grab the last 12 months and compare that against the year prior. And quite often, there might have been a uncharacteristic extra spend with a lawyer. Doesn't mean necessarily going through the courts, but it can be about anything to do in the legal side. Quite often it can be with employment relations. So taking a check on how much you're spending for legal advice. Quite often with accountants through COVID, we saw a lot of businesses spending extra money trying to get extra advice around grants and government support. So that's an area certainly to have a look at, but also with trades. A lot of my clients, I'm seeing significant extra spend with trades. Varying reasons. It might have been upgrades, or you're trying to outsource more, but quite often the trade price has gone up significantly. So having a look at those different areas, where have I spent more money and where can I actually pull back? Can I say to my accountant, look, I used you a lot more last year, but I'm going to pull that back to previous levels. Likewise with legal advice and also trades where you can. So who can I use less often? I touched on it earlier. Insurance is going up significantly with the risks that we've seen nationally and internationally. Some businesses in tourism, I know, actually can't secure insurance for certain parts of their business or at all. Some of our fellow tourism businesses in the Riverland who can't get insurance. But there are risks with insurance pricing. So a couple of the variables, knowing how to price. The first one is your excess. If you increase your excess that you're prepared to pay if a claim goes in, you can bring your premium down. The second one is areas that you insure. I see with quite a lot of my clients that they actually haven't reviewed their policy in the areas that they're insuring, and is it really important to them? And I encourage them to have a look. Well, when was the last time you made a claim? Well, how great is the risk for each part of your policy? And quite often there's opportunity to pull back on the areas insured or the sum insured. So that's certainly something to have a look at. And also the payment plan. A lot of my clients default that they want to pay monthly for cash flow, but quite often you pay a premium for your insurance by paying monthly. You're paying a higher price. So if you can, to pay up front, can bring through a pretty reasonable saving as well. So with your insurance, don't just accept that increase in price. Yes, it is going to go up, but a bit of a fight back and looking at different ways to soften that increase. Another way also is to broker. Tick's a partner with Gallagher's, and they'll go out to multiple insurance companies to price your insurance needs on your behalf. And that's a great way to very efficiently and effectively get experts out there pricing, getting the best deal for you. So I really encourage that. And the fifth one, am I expensive to run? Review variables to run utilities. So obviously there's three areas, electricity, gas and water. Electricity and gas, we've seen double-digit increases in those areas, and expected to continue to increase by double digits. So going through to electricity, again, the majority of my clients with accommodation, it's looking at LED lighting, it's looking at solar panels, but at the least, it's going to tender on your electricity needs. So working out your consumption and then putting that to different companies. And I see a very high success rate in just going to the market and even doing it twice a year, that you will get a reduction, quite often with the company you're already with, if you pitch them against other electricity suppliers. Gas is a little bit more difficult. It's a different commodity, so trying to get that cost down, but your gas consumption, and a big one with hotels, is related to hot water. And a lot of, and the next one I've got there is water. A lot of hotel properties aren't using water restrictors in their shower heads. And as a result, having significant up to 20 litres. I saw a property that I looked at last week, 26 litres per minute of water being used. And that significantly increased your water usage, but also your gas. So gas, yeah, going out to market, checking that price is competitive, and water, about conservation of water. And I'm seeing some businesses, even to their watering systems, actually connecting that to weather forecasts. So there's automatic cut-off if rain's forecast, etc. So really, really important is, again, pricing those areas, and tendering them, but understanding what the increase was previous years. So Kathy, before I wrap up, we have a great workshop coming up, a profit boost for tourism businesses. And if you're looking to protect profit, I'll be talking about a lot more of those 148 areas that I've listed. It's on the 13th of April, 9:30 to 12:30 p.m, and details on the TICSA website. The average client that I've worked with, we've saved hundreds of thousands of dollars in a year with these tips. So it makes a big difference. It's 29 years of work that I really want to share with people to help fight back against that rising inflation, labour rates that have gone up significantly, interest rates and the like. We've got to protect profit, and I'm here to help. So thank you, Kathy, for the opportunity.
Thank you, Owen, and I really do appreciate those insights, and positive to take some guidance for people to take away off of Pat's insight, to going, okay, well, what do I actually do, and where do I look? And you've just given some people some 5 real simple areas that they can look into their business. And further, Karen Ellis from Camel Tracks just popped on there about, the insurance situation and how challenging it is. And I'd like to acknowledge that, Karen, as well. So, through TICSA, we, as members of TICSA, we have a range of industry partners that are really here to support you and support our members through these taxing times. So I'd encourage you, we've been very generous to have Bank SA on the line today, and their generous offer. They not only, the wonderful knowledge that Pat has shared with us and insights he's given us, but that great offer for not just controlling your costs in a work sense, but also a personal sense as we're facing these challenging times as well with that generous cashback offer. So I'd encourage all our members to reach out to our industry partners and together with Bank SA, you know, we have insurance, we have people in the energy space with Flow Power and also P4B Solar in the solar space as well. So encourage you to do that. Like Owen said, if you want to learn more and pick his brains more with that 29 years of knowledge of doing it, actioning all these tips in practice, he's hosting a workshop for our members on the 13th of April. This will come out with post this webinar. We'll send an email out to you all with information, a recording of today, information to be in touch with David Brownie from Bank SA, Owen from Loftus Advisory, details of that workshop and that corporate offer as well, exclusive to you as a TIC SA member. Thank you, Owen. Thank you, Pat, and thank you, David. Appreciate your time and sharing your knowledge to our members today. Thank you to all our members on the call. I hope you've received some really informative information and some takeaways as well. Look forward to bringing you the next session. And in the meantime, have a wonderful day. Thank you. See you. Bye.
Thanks, Kathy. Thanks, everybody. Bye.